I'm here today at the first night of Lean's Lodge, Camp Kotok, with an old-time friend. I'm not saying old friend, I'm saying an old-time friend, Stu Hoffman, who was the former chief economist at PNC, and now leading a life of luxury or whatever. Tell us what you're doing now, Stu.
Actually, I'm still working full-time for PNC.
Okay.
4 years ago, a fellow who I had hired, Gus Fauché, took over as the chief economist. They asked me to stay for a year to kind of let him settle in, and 4 years later,
he still hasn't settled.
He settled in just fine, but they still have asked me to stay on because I do a lot of work with clients, not as much with the media anymore. But I do a lot of work with clients, and of course, in the world of the past year, I did everything by Zoom.
You mentioned the media. You said you heard something today from the Fed and the vice chairman.
Yes, Clarida was talking today, and basically he said that he thinks the Fed's conditions to raise interest rates, I guess both the inflation and particularly the employment conditions, will be met by the end of 2022. So I mean that's still that's still 17 months away.
Right.
But it was a little earlier and maybe a little more demonstrative than we've heard him say before.
Do you think that was his personal view, or do you think that's part of this communication strategy that the Fed seems to be following? Do you have any sense of that at all? Or?
I mean, I assume it's his personal view, but given who he is, and of course not knowing who's going to be chairman in the Fed, and I'm not sure how long he'll even be vice chairman, but given that he's one of the leaderships, I'm not saying he's speaking for the committee, he's speaking for himself, but I think he may represent a growing consensus in the committee that keeps moving forward the date of the first rate hike.
Do you know whether the market responded at all to those comments one way or the other at this juncture?
The market, it seems to be oblivious. I mean, the bond market didn't move, the stock market didn't move, FX didn't move, so I would have to say the market, maybe because it's August 3rd, but the bond market, the financial markets did not seem to respond.
The end of 2022 is 17 months away. That's a long way away to have announcements of potential policy moves. A lot can happen between then and whatever. What do you tell people today as to what they should do?
Well, let's think 6 months ago, the Fed was telling you they weren't going to move rates probably until 2024.
Okay.
And we got a vaccine. The smart people are taking it, hopefully more and more. And even with the Delta variant, hopefully we are going to move past this. And in June, the Fed's FOMC dot plot now had a majority expecting as many as 2 rate hikes in 2023. So I think the communication strategy is, given that inflation has been hotter, and it's probably going to stay a little hotter for longer, that rightly so, the Fed is looking at that and saying, waiting to 24 was way too long, and maybe it should be earlier in 2023 than later in 2023. And we're splitting the difference, PNC, we've been saying around the middle of 2023, but that's moved up at least 6 to 12 months from what we thought before we saw the June Fed dot plot.
Right. The Fed may have boxed itself into a corner with this average inflation rate if in fact actual inflation is accelerating and average inflation is a lagging indicator. Does that complicate their process and their analytics at all?
Marginal versus average. Economists deal with that all the time.
Exactly.
You know, the inflation rate in 2020, the pandemic year, the PCE deflator, was basically 1%.
Yeah.
This year, it's probably going to be 4%.
Right.
So if the Fed were to average the 2 years, 2.5% seems about where they want it. But there's a lot of standard deviation, more than they'd probably like, and a lot of extraneous factors. So I guess the real question is the underlying inflation rate still 2 or 2.5%, or is something closer to 3.5 to 4% going to stick around next year?
And to sort of get a sense of that, you have to go into the detail, I guess. And the Dallas Fed publishes
Trim mean?
They're trim mean, but they also have 178 components that they tell us. And it's interesting that more and more of the components have shifted to the upside in terms of inflation, which seems, and it's across a wider spectrum of activity than just activities that might be subject to supply shocks and supply constraints of one sort or another. So this is a difficult situation for them to be in. If you were on the board now, what would you do?
Well, back to what you just said before I answer that is rent. I mean, we know that rent has a 25 to 30% weight depending on whether it's the CPI or the Fed's PCE deflator. And rents seem to be going up faster and are likely to stay up as house prices, they follow house prices, which, you know, maybe, I hope they're not up 15% in the next year, but there's some catch up there as well. So I think there are some parts of inflation, as you said, reflected in the trim mean, that are going to have some permanence. And I still think inflation's coming down from 4% or so this year. But without a move from the Fed, and given I still believe in long lags for monetary policy, without a move in the Fed until the, say, end of 2023, I think that would have been a mistake. So I suppose if I were a member of the Board of Governors, although I've aged out, as I think you have as well, I'd probably be more thinking about early 23 as the time to start raising rates, and early 22 is the time to start tapering QE and get it done, within 6 to 9 months.
Well, we'll wait and see what happens. Thanks for your view, and hope you enjoy the rest of the visit here and lots of fish.
It's always great to be back, and good to see old, like you said, longtime friends like you and others. Great to do this, and great to see you.
Thank you. Good job.